Thank you very much. And thank you to Standard Bank for the platform to engage. As a Nigeria team, I'm here today with the Director General of the Security and Exchange Commission, the National Pension Commission, and colleagues from the Central Bank of Nigeria. And really, within the next few minutes is to outline for you some of the reforms that the Nigerian government has been undergoing over the last 2 years. And the last 2 years, really, the government has really gone through the most consequential reforms that have probably happened in the last 2 to 3 decades. And these are reforms that have really helped unshackle the economy in a way that we have started to see some significant impact. Nigeria's economic landscape, if you look at the GDP growth over the last 10 years, has been kept down mainly because of 2 unsustainable subsidies that the government has been paying. The first, the subsidy on petroleum products, and the second, a subsidy on foreign exchange. These 2 subsidies have both now been removed in May of 2023, with significant impact in the way that our oil industry now functions and the FX market functions today. And so, if you look at the GDP growth, prior to 2023, the third quarter of 2023, oil GDP had been in negative output for the last about 4 to 5 years. For the first time in Q4 of 2023, oil GDP became positive, and now we're seeing significant growth built out of domestic refining capabilities and also improved production from security and the opening of new fields. Inflation, still high, but has commenced a descent, and we're now really at a period where we're managing disinflation and seeing how to grow the economy. Benchmark interest rates still 27.5%, still pretty high, but positive real interest rates for the first time in about 5 years in Nigeria. Exchange rate is stable at 1.536 as of today, and banking sector manages about $70 billion in assets and growing. 70% of this growth just over the last year and a half. Stock market performance is strong, and we hope to engage at the sessions tomorrow and to discuss this in a bit more detail. So the economy really is at a major turning point for us from what we've seen in the numbers. And some of the potentials for investment across various sectors in infrastructure, in technology and digital finance, in agriculture, and solid minerals. And there are significant amounts of projects, bankable projects, that are available for investors to key in that promise decent returns. The currency, as you know, when we unified the rates in 2023, resulted in a devaluation of about 40%. Now, that move, which we consider to be largely positive, has given us a competitive currency relative to where we are, where we've been. Nigeria has always had an overvalued currency, which has deterred investment. Now, for the first time, we have a currency that is competitive and has now had a role in significantly boosting exports. If you look at exports last year, oil and non-oil, significant growth. And one of our biggest jumps is that our trade export destinations mostly now in Africa. So a diversification of exports as well. Over the last year and a half, significant monetary and fiscal policy reforms. Firstly, starting, as I said, with the removal of petroleum subsidies and the FX subsidies. Those 2 were costing the country almost 7% of GDP annually. Now, with that removal has come significant fiscal space because of improved revenues. And then, of course, as you all know, Nigeria has had an issue with an FX glut that started a while ago, but effectively has now been resolved. All outstanding commitments of FX have been resolved, and we have a much deeper foreign exchange market today. When we came in 2023, we had an FX backlog of about $7 billion. That's now mostly been resolved. We have a very much deepened foreign exchange market. As of 2023, turnover daily was around $120 million a day. Today, we're pushing to 500 and 600, and the target in the short to medium term is to really hit $1 billion of turnover. And what that means is that for investors that have invested in Nigeria over the last year and a half, entry has been easy, exit has been easy because there has been liquidity in the foreign exchange market. Revenue mobilization, as I said, Nigeria has had a very low revenue to GDP ratio. Today, we used to be at about 7%. Around the continent, it's about 20%. And now we're pushing at 12 and 13%. And some very, very consequential tax reform laws have just been passed over the last week, which will see us significantly ramping up on revenues. The central bank has transitioned fully to orthodox monetary policy, eradicating quasi-fiscal measures that have been a feature of the central bank in the past, and has really focused on trying to tame inflation, ensure price stability, and also exchange rate stability. Side by side with this is the adoption of an electronic foreign exchange matching system, which has brought a lot of transparency to the foreign exchange market and has reduced and eliminated almost the information asymmetry that used to exist in Nigeria's foreign exchange market. Today, all market players can see the volumes in the market, can see the bids and the asks, and are able to trade much better. We've also adopted an FX code, the global FX code, tailored back to Nigeria, which has helped with ethics in the market and to reduce as much as possible speculative activities. Side by side with that, the Ministry of Power has signed the Electricity Act of 2023, which has really brought cost-reflective tariffs and has really opened up the sector as well to investment possibilities. In terms of institutional reform and enhanced governance, we've really focused at the central bank on enhancing monetary policy transmission, doing a lot of work really on ensuring that the decisions that are taken at the Monetary Policy Committee transmit through the economy and are able to get a hand on inflation. For this year, we're hoping to hit a target of about 15% of inflation, down from 23.18% that we are today. So there is a huge amount of work going on in fortifying public finance buffers and ensuring really that we build financial sector health. Banks from Nigeria are undergoing capitalization efforts from now till next year, which we hope will really help the economy as it really strives to achieve its target of building $1 trillion economy over the next 10 years. So in terms of real sector reforms, there's been an adoption of value chain approach to agriculture and manufacturing, really trying to decouple it and ensure an efficiency at every stage of the chain, a development of electricity and mineral sectors, transportation networks and port decongestion. These are all opportunities that are available within the Nigerian economy for investors as much as possible to key in. And we'd hope to be able to engage on these in more detail, maybe at the country sessions tomorrow. In terms of financial sector reforms, we've been really focused on trying to get Nigeria off of the gray list. We're very confident that over the next few weeks, we will hear back, and we're quite positive that we'll be able to get off that. So there's been a lot of work on, as much as possible, trying to raise capital for the banks, as I've mentioned, and other key players in the financial sector. The Ministry of Finance and other parts of the fiscal side are modernizing fiscal policy, trying to improve. There's really a strong focus on revenue generation in Nigeria today, and it is yielding fruit. We've seen significant improvements in revenue generation, revenue mobilization, both at the subnational and at the federal government level, public procurement reforms, and efficient administration of social cash transfer programs. Of course, some of the effects of the reforms have been really negative effects on the cost of living at the initial stage, but now, as much as possible, that is being alleviated. In the past in Nigeria, if you followed the economy, from 2019 we had 2020, there was a 13% premium between the official, quote unquote, and the parallel exchange, parallel foreign exchange market. That went all the way up to 52%, identifying significant arbitrage opportunities. That is now down to less than 2%, really showing convergence and a unification of the rates out of the policies that have been implemented. Foreign exchange flows through the economy have significantly improved. As I mentioned, on a daily now we're looking at about $400 to $500 million from $100 million that it used to be. And our target, of course, is to be able to hit $1 billion on a daily basis. Over the last few months, if you look at the balance of payments for 2024, we've had current account surpluses. For 2023, it was $6.9 billion, but for 2024, we've had a current account surplus of about $18 billion, which is significant and really, really shows where the economy is changing. And this is coming from a position where we've had significant current account deficits from 2022, 2021, and beyond that. So in terms of external reserves, also growing. We hit about $40 billion in December. We're using it, of course, to settle debt obligations and then to supply FX into the market as well as required. But we are really focused now on the first phase of our plan to ensure that we build a liquid foreign exchange market before we come back. But because of the surpluses that we have from the current account, it's also allowing for natural reserve accretion as we go forward. The All Share Index, I'm sure the SEC will talk a bit more about this tomorrow, is also seeing strong market performance and broad-based growth, and it is a market that's still deepening, and we hope will get better in a way that it supports the economy. Inflation is easing amid structural adjustments and market dynamics. So whereas we have been on a very, very challenging period in the recent past, we are seeing significant opportunities to really tighten or right decades old of challenges that have affected the economy. And with inflation coming down, both headline and core and food, we see that there's significant opportunities as well for some stability in the market. Liquidity policy, liquidity conditions, of course, with the improved revenues from the fiscal side, some of the headaches that we have from the monetary side is always continuing to absorb that and ensuring that the market rates are reflective of the liquidity conditions that the central bank requires for inflation to continue to be within target. On the oil sector, there's been significant investments in security and infrastructure, which have resulted in a boost in oil production to 1.56 million barrels per day in 2024. New refineries coming on stream. Dangote has ramped up production. Port Harcourt, Warri, Kaduna is coming on this year. So we're seeing generally improvement in domestic oil refining, which has really taken out the 30-40% of oil imports that Nigeria used to make, which has resulted in, of course, a positive effect on our balance of payments. The government has also had a policy on compressed natural gas to ensure that there's cheaper alternatives to the citizenry in terms of energy sources, and also the rise of key local players that are also really positively affecting the oil industry in Nigeria. So there is significant avenues for investment as well within this sector, and we will be available to talk a little bit more about this tomorrow. For the outlook for 2025, growth projections are broadly positive. We expect to hit about 4.17% growth, and we think that that would be something that would be able to significantly improve upon next year. What the economy has gone through is a deshackling of some of the things that have really kept it down for probably 20, 30 years, as I've mentioned. And really, it's an economy that's on the verge of really true and sustainable liftoff. You can see the federal government revenues really improving, as I've mentioned, and this has implications for a huge number of our macro indicators. Money supply also reducing, and we are working to continue to tighten till we get to our targets. And then that's why we have a fiscal monetary committee now that's really looking at disinflation and growth and how to really transition that in a way that does not affect each one negatively. Thank you very much for listening, and we hope to engage again tomorrow. Thank you.